In the world of income investing, two exchange-traded funds represent a fundamental clash of strategies. Today, we're putting them head-to-head, the high-yield covered call approach of YMAX against the modern leverage structure of WPAY. It all begins with an incredibly powerful number. The promise of yields exceeding 50% is a siren call for any investor focused on generating substantial income. This naturally leads to the core question of our analysis. Are these yields a sustainable pathway to financial freedom, or do they mask a hidden, unacceptable cost? Let's find out. Our investigation starts with YMAX, the YieldMax Universe Fund of option income ETFs. As a leading example of the covered call strategy, understanding its inner workings is the first critical step. The engine driving YMAX's massive distributions is the synthetic covered call. In simple terms, the fund generates its income by selling away the right to future profits on its underlying assets. In return, it collects an immediate and substantial cash payment, which is then passed on to you, the investor. Herein lies the fundamental trade-off. That high premium income is not generated out of thin air. It is a direct exchange for forfeiting all potential appreciation above a specific price. This means, in a rising market, you are contractually obligated to give up your upside. The source material captures this dynamic with a powerful phrase. By capping your potential for gains, the strategy acts as a velvet handcuff, effectively preventing your investment from participating when the market truly takes off. This chart shows the result in the real world. So far in 2025, YMAX's total return has done nothing more than match the S&P 500. Despite its complex option strategy, it has delivered zero alpha, that is, zero outperformance against its benchmark. It gets worse. A more insidious risk is that of NAV erosion. If those high distributions are not paid from real earnings, but are simply a return of your own invested capital, the fund's underlying value, its net asset value, will slowly decay, eating away at your principal. This combination of a capped upside and the potential for a decaying asset base has led critics to a rather stark conclusion, labeling the entire structure a ticking time bomb. Now, let's pivot to the alternative presented in our analysis, WPAY, the Roundhill WeeklyPay Universe ETF. It represents a completely different philosophy for generating high income. The strategic difference is clear from the outset. WPAY's method does not involve covered calls, which means there is no structural limit placed on its potential for capital appreciation. The handcuffs are off. So how does it generate income? Instead of selling its upside, WPY aims to amplify it. It employs financial derivatives to target 120% of the weekly performance of its underlying holdings, which are primarily the Magnificent Seven tech stocks. This leveraged approach has delivered a striking total return of 9.8%. And to put that number in perspective, this return was achieved in under 1 month of the fund's existence, demonstrating the power an uncapped leverage strategy can have in a positive market. This brings us to the direct comparison. Placing these two ETFs side by side allows their opposing philosophies on risk, reward, and market outlook to become perfectly clear. This table breaks it all down. YMIX sells its upside for today's income, while WPAY seeks to amplify weekly performance. YMIX's upside is capped, WPA's is not. The primary risk for YMIX is underperformance and NAV decay, making it suitable for stagnant or declining markets. For WPA, the key risk is amplified volatility on the downside, making it a tool designed for bull markets and uptrends. Ultimately, the choice reflects an investor's core fear. YMAX is for the investor who is most afraid of a disruption to their income stream. WPA, on the other hand, is for the investor who is most afraid of missing out on a powerful market rally. With this comprehensive analysis laid out, we can now arrive at a final verdict regarding the merits of these competing income strategies in today's market environment. The judgment from the source material is decisive. It argues that covered calls are a relic, a strategy structurally engineered to underperform during the very periods of market expansion that are most crucial for long-term wealth creation. Let's review the essential takeaways. First, headline yield figures can hide the significant cost of forfeited gains. Second, covered call strategies are built to underperform in bull markets. Third, leveraged strategies provide an alternative for high income without sacrificing that upside potential. And finally, your investment strategy must adapt to prevailing market conditions. This analysis leaves us with one final critical question to consider. In a market environment defined by growth and upward momentum, why would any investor deliberately choose a strategy that places an artificial ceiling on their own success? For more data-driven analysis to help you make smarter investment decisions, please like this explainer and subscribe to Finbot Insights. Thank you for your time.